7 questions 50% CFA Level 1 candidates failed to grasp, including one crucial one at the end. DuPont analysis, the decomposition of ROE. Question 7. Based on this data, which conclusion is the analyst most likely to reach? A company X's higher ROE in FY15 is partly due to an investment in more efficient assets. B. The minimal difference in FY15 ROE is primarily because Company X used more debt financing to compensate for its lower operating profitability. C. Company X's edge in ROE can be explained by its strategic focus on more profitable products. Correct answer, B. DuPont 5-way ROE analysis shows Company X and Company Y had nearly identical ROE in FY15, despite different financial paths. Company X's ROE increased due to higher leverage offsetting declining operating profitability. This contrasts with Company Y, which achieved a similar ROE increase without relying on increased debt. Company Y's ROE increased due to improved operating profitability and asset efficiency, not increased leverage. Company X's ROE increased despite declining EBIT margin due to increased leverage. Question 6. Which of the following choices best describes reasonable conclusions an analyst might make based on this ROE decomposition? A. Profitability and solvency both improved in FY12. B. The higher average tax rate in FY12 offset the improvement in profitability, leaving ROE unchanged. C. The higher average tax rate in FY12 offset the improvement in efficiency, leaving ROE unchanged. Correct answer, C. DuPont 5-way decomposition shows ROE remained constant at approximately 17.50%, despite changes in its components. Tax burden impact. Lower tax burden 0.72 to 0.68 led to a higher average tax rate, negatively impacting ROE. Asset turnover impact. Improved asset turnover 1.55 to 1.65 positively impacted efficiency. Overall ROE impact. Higher tax rate offset efficiency gains, resulting in a flat ROE. A. Incorrect. Profitability, EBIT margin unchanged, no solvency data, with debt ratios, coverage. B. Incorrect. Profitability, EBIT margin did not improve, efficiency, turnover did. Question 5. Which of the following is most likely a contributor to the company's inferior ROE compared with that of the industry? The company's lower. A. Tax burden ratio. B. Financial leverage. C. Interest burden ratio. Correct answer, B. DuPont 5-part ROE components: tax burden, interest burden, EBIT margin, asset turnover, and leverage. Leverage impact on ROE. Lower leverage negatively impacts ROE by reducing financial amplification. Interest burden impact on ROE. Higher interest burden positively impacts ROE by reducing EBIT loss to interest. A. Incorrect. Tax burden identical, not a contributor. C. Incorrect. Higher interest burden improves ROE, lower interest drag, not worsens. Question 4. A company reports the following financial data for the most recent fiscal year. Return on equity, 12.5%. Net profit margin, 5.0%. Revenue, $1,500,000. Average total assets, $1,200,000. The company's average shareholders' equity is closest to $468,750. B. $600,000. C. $937,500. Correct answer, B. Net income calculation. Net income is calculated by multiplying net profit margin with revenue. Net income value. Net income is $75,000. Average shareholders' equity calculation. Average shareholders' equity is calculated by dividing net income by return on equity. Question 3. An analyst has gathered the following financial ratios for a company. Net profit margin, 8.2%. Total asset turnover, 1.25 times. Return on assets, 10.3%. Financial leverage, 1.85. The company's return on equity is closest to a 15.2%, B 19.0%, C 21.4%. Correct answer, B. ROE is calculated as net profit margin multiplied by total asset turnover and financial leverage. ROA is calculated as net profit margin multiplied by total asset turnover. An ROE of 18.96% means the company generates 19 cents of profit per dollar of shareholders' equity, indicating moderate leverage and efficient asset utilization. Question 2. Based only on the information above, the most appropriate conclusion is that over the period FY13 to FY15, the companies A net profit margin and financial leverage have decreased. B net profit margin has decreased, but its financial leverage has increased. C net profit margin and financial leverage have increased. Correct answer, B. DuPont analysis formula. ROE equals ROA times financial leverage, and ROA equals NPM times asset turnover. Net profit margin equals ROA divided by total asset turnover. NPM declined from 4.11% in FY13 to 3.52% in FY15, indicating lower profitability per dollar of sales. Financial leverage is calculated by dividing ROE by ROA. Financial leverage increased from approximately 2.37 in FY13 to 2.95 in FY15, indicating greater use of debt to boost ROE. ROA declined from 7.8% to 7.4%, while ROE increased from 18.5% to 21.8%, suggesting that the increase in ROE was driven by higher leverage rather than improved profitability. One crucial question. Question 1. An analyst has gathered the following performance metrics for a company. Return on equity, 15%. Return on assets, 9%. Asset turnover, 1.8. Tax burden ratio, 0.5. Interest burden ratio, 0.75. What is the company's pre-tax profit margin most nearly? A 8.3%, B 10.0%, C 12.5%. Correct answer, B. Leverage is calculated as ROE divided by ROA, which is 15% divided by 9% equals 1.6667. ROE decomposition. The 5-component DuPont ROE formula is used to break down ROE into tax burden, interest burden, EBIT margin, asset turnover, and leverage. EBIT margin is calculated as ROE divided by the product of tax burden, interest burden, asset turnover, and leverage, resulting in 13.33%.